We mark the last candlestick before the start of a drastic bullish move as our order block zone. Regardless of the candle color, we believe that the decisions are made during this candle, which makes it an important area where the buying orders reside. When the price taps into this area again, we will open a buy position and set our stop below the zone. In some cases, we even look for more confirmations and entry setup in the lower time frames, which we will discuss in the future videos. Same concept for the bearish scenario. We mark the last candlestick before the start of a drastic bearish move as our order block zone. This is the basic form of marking the order blocks on the chart. But in some scenarios, we would have some adjustments. For example, sometimes a wick grabs the liquidity below the order block candlestick, which makes us add this wick to our zone. But the problem is, we would have a large order block to trade. That's why in situations like this, we will look for more confirmations in the lower time frames to execute trades at a better price. Sometimes the candlestick that created the order block is a very small one. There is a chance that the price will mitigate this zone and respect the low, but it is not a law. If you trade this on the real chart, you will notice that many times the market will break through these areas before start pushing upwards. So, in situations where the order block contains a small area, we will set a large stop loss below the order block, or we consider a larger area on both sides. But how do we know that this candle is smaller than the average candlestick range? We will measure it by applying the ATR indicator on the chart. The average true range, or ATR, is an indicator that measures market volatility. It gives you the average size of the previous 14 candles in default settings. So here is an extra rule for marking the order block zone. If the order block candlestick is smaller than 60% of the ATR, we will extend our zone to 1 ATR from both sides. For example, here the ATR shows that the average size of the past 14 candles is 20 pips, so if the order block range is lower than 60% of 12 pips, we will extend our order block zone to 20 pips. Now, based on the market structure concepts, 3 kinds of order blocks form on the chart: continuation, reversal, and ranging order blocks. Continuation order blocks happen when the price is trending upward or downward, and order blocks form aligned with the dominant trend. For example, imagine that we have an uptrend with a series of higher highs and higher lows. Each of the demand order blocks that form along the way is an opportunity to go along with the dominant uptrend. But if a change of character appears, a supply order block automatically will form, which is against the dominant uptrend. Usually, the continuation order blocks have a higher chance of success because they are in line with the trend. However, reversal order blocks have the potential to gain massive risk-to-reward ratios. The next order block is the ranging order block. This kind of order block forms when the price is in a range phase before a drastic move happens in the market. When the price returns to the ranging zone, we expect the market to reject this area and continue pushing upwards. From the visual perspective, identifying the range zone is easy. It feels like the price is trapped inside the box. However, from the mechanical perspective, we need at least 4 consecutive candles, each one closing back inside the range. Now, all of the rules and conditions we have discussed so far are crucial for identifying valid order blocks. However, there is one important factor that needs to be considered to increase the chance of winning trades: combining order blocks with market structure concepts. Finding an entry zone alone is not enough for a successful trade. That's why we always apply a top-down analysis to the chart to gain a comprehensive understanding of the current market condition and future movements. This top-down analysis consists of 3 major time frames. Starting with the 4-hour chart, we apply the concepts of market structure to the chart to find the market direction, key levels, and supply and demand areas. Following, we zoom into 1 hour, which is our major analysis time frame. On the 1-hour chart, we identify the trend, breaks, reversals, fair value gaps, liquidity areas, order blocks, and trading opportunities. Furthermore, we zoom into 15 minutes to find confirmations in the lower time frames and execute orders. So guys, that's it for this video.